Gold gets a bit of a breather this Tuesday, and two heavyweights battle it out on the Twitterverse over the price of gold. We'll be getting Peter Hugg's thoughts up next. Peter, thanks for being with me this Tuesday.
You're welcome, Danielle.
Peter, I know last night when we were speaking, you had a feeling gold would recover slightly this Tuesday morning. How did you know? How did you have that feeling?
No, if I could explain that, I probably would have stayed in retirement. You just sometimes get a sense on how the market positions itself. And yesterday, although it didn't break up through the 1578 level, it just appeared that there was some short covering and some bargain hunting coming in, especially in the silver market, which has been pounded over the past month or so. And I wasn't prepared to put a trade on this morning when I sent my blog out, but my feeling, again, and I put that in quotation marks, was that I sensed that a higher market was coming today, and it turned out to be true.
So, Peter, you weren't basing it on any fundamentals?
No, I wasn't actually. I mean, if you look at the fundamentals, which was my blog from Thursday, I think that created the short covering rally. We suggested last week on Thursday that a pop was coming in this market, and it may be prudent to take the profits on the short trade. I mentioned on my Thursday blog that there were things such as the Korean issue, which again I don't think is a significant issue, but it's a perception issue. Some of the issues with Europe, the Japanese with their huge stimulus announcement over the weekend, which is about twice the size of the Fed on a GDP basis. We're all indicators that if I were a bear and still short the market, would have made me nervous and caused an event where I would have covered at least half my position. And I think that's what we've seen over the past 2 days.
Peter, let's talk about some good bedtime reading that was given to us last night, courtesy of economist Nouriel Roubini and the author of Currency Wars, James Rickards, who's been on our show before. They were battling it out over the price of gold. Roubini saying gold sinking towards 1,500. Take that, basically, you gold bugs that were calling for $10,000 gold. Rickards was quick to reply, saying that yes, gold is lower because the U.S. dollar is higher, and he expects sideways trading to continue with gold throughout the year. What do you think about this debate that took place?
Well, I think Roubini's late to the party. I mean, if his target is $1,500, I'd like to see where he was when gold was at 17 and a quarter. $1,500 from today's morning's level is 3% or 4% away. From the lows recently, it's less than 3% away. So, if Roubini is saying that $1,500 is the target, then given the fundamentals that are out there, and I certainly don't think Europe by any stretch of the imagination is resolved. I think the U.S. still has issues. I still think the Fed is going to keep its foot on the accelerator at least through the end of this year, if not longer. You're sacrificing or you're risking $80 on the downside if he's right, to potentially back to $1,800 on the upside if he's wrong. And, every central bank I'm looking at is accelerating their monetary stimulus. The ECB, it is just a matter of time, in my opinion, before they start dropping interest rates. I think why they're not dropping interest rates is they do not want to give a perception to the market that their issues over there are as bad as people may believe they are. So by keeping interest rates where they are, they're at least making the point that they feel comfortable with the recovery in Europe. And I just don't buy it.
Right, as you say, Peter, $80 on the downside doesn't seem so much as a risk right now, and $1,500 gold is, relatively speaking, still high.
Yeah, obviously it was a slow news day, and they had some fun with it yesterday.
Another comment made in the debate last night was that gold is up 25% in yen, Peter, and I know that's something that really annoys you when gold is looked at other currencies besides the U.S. dollar.
Well, what does that mean to a North American investor? Some serious players out there that have the ability of borrowing yen at zero and then buying gold and then repaying the yen as the yen drops, that would make sense. But for the average investor, what does that mean? Gold is up 25% against the yen, but how does the average investor play that? You certainly don't buy gold against the yen. If you're going to play it as the average investor, you just short the yen against the dollar, and actually you'd be up more than 25%. So it bothers me when people make those comparisons. Yeah, I'm very bearish gold against the dollar, but I'm bullish gold against the euro. Okay, if you're speaking to a European audience, that would make sense. But speaking to a North American audience, I don't see how you make that trade as the average investor.
Speaking about prominent figures, George Soros going on the record earlier this week saying and stating that gold, he no longer sees it as a safe haven, Peter. What do you think about that? How do you view gold right now? Currency or commodity, safe haven or not?
Well, again, with Soros, I think he's late to the party as well with his comment. In 2008, when we ran through the financial issues in the United States and then subsequently with the European issues, gold was at $700 and it traded up as high as $1,920 or higher, 27, I believe, at the high. And that was obviously a move to a safe haven position. And recently, the U.S. economy has shown some signs of stabilizing and getting better. The European economy, the headlines aren't there. So there is less perception that the world is in serious economic turmoil. And as a result, some of the luster has come off gold as a safe haven asset. But to make a statement that gold is not a safe haven asset, I think is, I'll use the word, I think immature, because I think all through history, since gold was traded off the gold standard, whenever there were serious geopolitical events or financial events, gold always reacted extremely well as a safe haven investment. Now, if Soros believes that the world is a perfect place and everything is fine, then yes, I agree with him that gold will probably have less of a place in a portfolio to protect against those types of events. But I'm not in that camp. I do not think that the European situation is resolved, and I do not think that the U.S. situation, given their budget deficits and the monetary expansion, is a resolved issue. And now you add the Japanese to it. And then on top of it, you could add the geopolitical risks of North Korea and Iran and blah, blah, blah. And once any of those things ignite, gold will again be a safe haven asset.
Immature to say gold is no longer a safe haven. Thanks, Peter Hug. But how do you play this game now as an investor? What do you do with these price points?
I hate it when the question is I hate it when the question is asked of me that way. I mean, I think, and I still firmly believe, that there are enough risks in the market to substantiate a portion of your assets in gold. But again, to reiterate my position on that, you need to recalibrate that on a quarterly basis. So if you have bought gold at $1,900 and you're dismayed now because gold is at $1,500, if you recalibrate that position to your portfolio, again, assuming you wanted a 10% holding as an insurance position, then it would be, I would suggest, at these levels, your calibration is probably at 6 or 7%. So you would want to buy 3% more. So you're averaging down as the market drops. And then if the market does rally up, your portion will be higher than 10%. So you'll be selling. And that type of formula will allow you to enter the market on drops and exit the market on rallies. So that's the investor. I have not changed my position there whatsoever. As a trader, as I continuously say in my blogs every morning and on air or when I'm interviewed, I have absolutely no loyalty to the market. I couldn't care less if it went to $1,400 or $1,800. I'm only interested in volatility and taking trades, sometimes on an hourly basis. Sometimes the trades are a little longer depending on the momentum of the trade. But that is totally divorced from the logic of holding a portion of your assets in metals.
Peter, hate is such a strong word, and you gave such a good answer that you should be thankful I'm asking you that question. Okay, finally, Peter, any words of comfort for silver lovers out there? Well,
silver was massively oversold on a ratio basis against gold. We suggested when silver was down in the 26 range that a serious pop was coming, and it's materialized. Silver's up just a little over 8% since we made that recommendation. Silver is an animal that will trade with gold. I think the ratio will hold between 52 to 57 ounces of silver to an ounce of gold. And, if we can get a run in gold, I think silver is extremely inexpensive at these levels. I'm still cautious this market. I'm still not convinced that we will not see what Roubini suggests is possible, the low 1500s. And then I would have to reassess. I still think 1527 is a serious support level for gold, which again would take silver down into the mid 26s. But if gold breaks up through 1600, you're going to see silver at $30 in a blink.
Silver is an animal that follows gold. Peter, how do you even think of these expressions?
I have a strange mind.
All right, Peter, thank you for joining me, and we'll see you next week.
Okay, Daniela, you're welcome. Bye-bye.
And thanks for watching this edition of For Pete's Sake. You can email us at newsfeedback@kitco.com or follow this conversation at Daniela Cambone. Thanks for watching.